Take everything you think you know about money and set it aside for a second. The dollars sitting in your checking account right now were almost certainly never printed by the government. No machine stamped them. No bolt holds them. They are just numbers in a database that one day did not exist and the next day did. Here's the number that breaks most people's mental model. In the United States, the total stock of money that people and businesses can spend, what the Federal Reserve calls M2, stands at roughly $23 trillion, but the amount of actual physical cash, the paper bills and coins, is only about $2.3 trillion. The rest is digital. So if roughly 90% of the money in the economy was never printed as cash, where did it come from? Who made it? The honest answer is one that almost nobody is taught in school, and when central banks finally spelled it out in plain language, a lot of economists were uncomfortable. The money was created by ordinary commercial banks. In 2014, the Bank of England published a now famous paper called Money Creation in the Modern Economy. They wrote it specifically to correct what they called common misconceptions. Their conclusion was blunt. The majority of money in the modern economy is created by commercial banks making loans, not by the mint, not by savers, by banks when they lend. That is the question this video answers. How does a bank create money out of nothing? Is it legal? Is it a scam? Or is it just how the system has always quietly worked? And most importantly, what does it mean for inflation, for your savings, and for the value of every dollar you earn? Let's start from the very beginning. Chapter 1. To understand how money is created, we first have to be honest about what money actually is today, because it is not what most people picture. For most of human history, money was a thing you could hold. Gold coins, silver, paper notes backed by metal in a vault. The money had to physically exist before you could spend it. That instinct is still buried deep in how we think, and it's exactly why the modern system feels so strange when you first see it clearly. Today the picture is flipped. According to the Bank of England, more than 97% of all the money in the economy exists as bank deposits, just digital entries on a bank's computers. Physical cash is the tiny sliver left over, so when you say you have money in the bank, you do not have cash there. You have a promise from the bank to pay you cash. Let that sink in. The number on your banking app is not a count of bills in a drawer with your name on it. It is a liability, a debt the bank owes you. The bank is promising that if you ask, it will hand over physical cash or send those digits to someone else. Money in the modern economy is, at its core, a promise that everybody has agreed to trust. There are actually a few different layers of money, and mixing them up is where confusion begins. There is physical cash you can hold, there are commercial bank deposits, the digital money in your account, and there are central bank reserves, a special kind of money that only banks themselves can hold and use with one another. Keep those three apart, and the whole system suddenly makes sense. Once you accept that money is mostly just trusted digital entries, the next question becomes obvious and a little unsettling. If money is a number a bank can type, then what actually stops a bank from typing more of it? What is the break? The answer reveals the real engine of money creation, and it runs on something you might not expect. Debt. Chapter 2. The single most important idea in this entire video, and the one that flips the textbook story upside down, the loan creates the deposit. Here's the story almost everyone believes. Savers put their money in the bank keeps a little, and lends the rest out to borrowers. The bank is just a middleman, passing existing money from people who have it to people who need it. It is a clean, intuitive picture. According to the Bank of England, it is also wrong. What actually happens is the reverse. The Bank of England put it in one devastating sentence. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The bank does not move money from a saver to you. It writes a new number into your account that did not exist anywhere a moment before. Picture it step by step. You walk in and ask for a $50,000 loan to buy a car. The bank approves it. It does not go find $50,000 in a vault. It simply types $50,000 into your account balance, and at the very same instant records that you owe $50,000 back. Two new entries, created together, out of nothing but a keystroke. Notice what just happened. Before the loan, that $50,000 did not exist. After the loan, it does, and you can spend it on a real car from a real dealer. The bank manufactured new money simply by extending credit. This is why economists say money in our system is created as debt. Almost every dollar in existence is somebody's loan. And here's the mirror image. When you pay that loan back, the money does not get handed to a saver. It is destroyed, the deposit shrinks, the debt is cancelled, and that money vanishes from the economy just as quietly as it appeared. Money is created when banks lend and destroyed when loans are repaid. The whole supply breathes in and out with debt. Chapter 3. So if banks can just type money into existence, what on earth stops them from creating an infinite amount? Time to meet the multiplier myth and the very real breaks that replaced it. The classic textbook answer is the money multiplier. The idea goes like this. A bank must hold a fraction of every deposit in reserve, say 10%, and can lend out the other 90%. That lent money gets redeposited, lent again and again, so an initial deposit multiplies into a much larger pile of money across the banking system. This is where the phrase fractional reserve comes from. It is a tidy story, and it is what most of us learned, but the Bank of England specifically pushed back on it. In reality, they argued, banks do not wait to gather deposits before lending, and they do not mechanically multiply up reserves. They lend first, creating deposits, and find the reserves they need afterward. The multiplier describes the cause and effect backwards, and in the United States, the reserve part of fractional reserve is now literally zero. In March 2020, the Federal Reserve cut the reserve requirement ratio to 0% for all depository institutions. Banks are no longer legally required to hold any fraction of deposits in reserve at all. The old multiplier story does not just describe the wrong mechanism, it describes a rule that no longer exists. It's what actually limits money creation, not a reserve ratio but real economic forces. Banks lend only when they expect to profit and be repaid, so they are limited by creditworthy borrowers. They are constrained by capital rules that require a cushion against losses. And above all, they are constrained by the central bank, which sets interest rates that make borrowing cheaper or more expensive. This is the crucial correction. The brake on money creation is not a vault full of cash, and it never really was. It is the price of money, the interest rate, and the willingness of banks and borrowers to take on debt. When borrowing is cheap and confidence is high, banks create money fast. When rates rise and fear spreads, money creation slows and can even reverse. Chapter 4. If commercial banks make most of the money, then what exactly does the central bank do? The answer is a second hidden kind of money that you never touch. There are really two parallel money systems running at once. The first is the one you live in, commercial bank deposits, the digital money in your account created by banks when they lend. The second is a wholesale system that only banks and the central bank can use, made of central bank reserves. You can never hold a reserve, but the entire economy depends on them. Think of it as two tiers. Commercial banks create the money the public uses, the deposits that make up over 97% of the total. The central bank creates a different money, reserves, that banks use to settle with each other and to back up your withdrawals. The public's money is made by private banks. The bank's money is made by the central bank. So the central bank does not directly print the money in your account. Instead, it influences how much of it gets created. Its main tool is the interest rate. Raise rates and borrowing gets expensive, fewer loans are made, and money creation slows. Cut rates and the opposite happens. The central bank steers the flood. The commercial banks open the taps. But there is one situation where the central bank creates money on a massive scale, directly, quantitative easing. In a crisis, the central bank can create brand new reserves out of nothing and use them to buy bonds and other assets from financial firms. This injects fresh money into the system from the top down, separate from ordinary bank lending. We saw it at a scale never witnessed before in 2020. Here's what that scale looks like. In response to the pandemic, the US money supply exploded. M2 grew by roughly 27% year over year in early 2021, by far the fastest expansion in modern American history, and rose by more than $6 trillion from the start of 2020. Money creation, both by banks and the central bank, went into overdrive. Chapter 5. Now the part that actually touches your wallet. What does all this money creation mean for inflation and for you as someone trying to save? Start with the basic intuition. Money gets its value from being scarce relative to the goods and services it can buy. If the supply of money grows much faster than the supply of real stuff, each dollar is chasing a smaller share of the same goods, and prices tend to rise. That is the simplest way to picture inflation. More money, eventually, can mean less value per dollar. But be careful, because the relationship is not a simple lever. Inflation depends on many things at once. How fast money is actually spent, how much the economy can produce, supply shocks, expectations, and confidence. Economists genuinely debate how tightly money growth and inflation are linked in the short run. What is clear is that money creation is one powerful force among several, not a single magic dial. Here's why this matters for you personally. If the money supply can be expanded by lending and by central bank action, then cash sitting still tends to lose purchasing power over time. The dollar in your pocket is not a fixed unit of value. It is a share of a pie that can be sliced thinner. Over decades, that slow erosion is the silent tax that catches savers off guard. It also reframes debt. In a system where money is created as debt and the supply tends to grow, being a saver and being a borrower are two very different positions. None of this tells you what to do with your own money, and this is not financial advice, but understanding that the dollar is an elastic managed thing, not a fixed rock, changes how you read every financial headline. So let's pull the threads together into the things actually worth remembering. Most money is created by commercial banks when they lend. The loan creates the deposit, not the other way around. Reserves no longer limited the way the textbooks claimed, and the central bank steers the whole process through interest rates, and in a crisis, by creating money directly. So step back and look at the whole picture. The money in the modern economy is not a fixed treasure that was dug out of the ground and divided up. It is a living, expanding web of promises, created mostly by private banks every time someone borrows, and managed from above by central banks. It is one of the most powerful systems humans have ever built, and almost nobody is taught how it works. Once you see it, you cannot unsee it, and you will read the economy differently for the rest of your life. If this changed how you think about the dollars in your account, follow Market Minute, because we break down the machinery of money one clear piece at a time. And tell us in the comments, did they teach you any of this in school? We're betting the answer is no.